What are the best dividend producing assets for your portfolio in retirement? Investors tend to universally agree that growth or low cost broad market ETFs are the best investments when we're accumulating wealth before retiring. But as soon as we finally reach that special day where we can walk away from our job forever, the debate about what to do with our portfolio heats up a little bit. I think I land on the less popular side in that I favor lower yielding dividend ETFs that focus on growing the dividends. I don't want inflation eating away at my purchasing power in retirement. A lot of retirees like to invest in real estate for the higher yield and the more stable income. In this video, we're going to dive into why investments like the monthly dividend company, Realty Income, ticker symbol O, are eating away at both your portfolio value and your purchasing power long-term compared to the alternative options. And this isn't just a clickbaity hook. There is objectively a winner in these retirement situations, whether you're reinvesting the dividends or not. Stick around to see detailed comparisons of multiple retirement scenarios. If you're new to the channel, welcome. My name is Jeff Teeples, and here we aim to grow your wealth with simple, time-tested solutions. Please face roll that like button, subscribe if you haven't already, and drop me a comment below with when you plan to retire, or if you're already there. We have 14 new channel members this week. This is getting ridiculous, you guys. A huge thank you to all of you. It really does mean a lot, and as cheesy as it sounds, you really are making what started as a dream a reality for me. I love making these videos, and I genuinely want to help as many as possible. Let's grow. High-level portfolio view. The most important variable in all retirement scenarios are just going to simply be your portfolio value at the time you retire. If someone, for example, has $10 million to retire on, they clearly won't need to focus on high-yielding assets to get by. They would be more focused on dividend growth to combat inflation over the years. I think a lot of us will have anywhere from $500,000 to $1.5 million by the time we retire after working a full career. So I'm going to use around $1 million for a lot of these retirement scenarios. Just know that these same basic principles will apply regardless of the portfolio value. And if you're brand new to your investing journey and $500,000 or more just seems completely outrageous, I understand, I hear where you're coming from, but don't lose faith. The compounding effect of your investments will add up a lot faster than it seems like is reasonably possible. Check this out. Okay, this spreadsheet is the portfolio projector, and this is out there for the channel members. You just put in your basic information, such as monthly contributions, total starting investments, your date of birth, and if you put in today, like I have here, it'll just give the age as how many years from now, and the assumed growth percentage. We're gonna use 10%, what the market's gone up the last 100 years. So if you can put in $500 a month, including company matches, which you will have no problem doing eventually. If you look in 30 years, you'll have over $1 million. Now, if you could do $1,000 a month, again, including company matches, so you don't have to put in that much, which is very realistic once you get going in your career, you will have, after 30 years, almost $2.3 million. So the $1 million that we're using for the scenario later in the video is not that far-fetched, you guys. You can do this. It never feels like it's adding up much, but it really does. The key to this stuff is just to start now. Build a well-balanced portfolio based around your goals and risk tolerance and things like that, and just dollar cost average aggressively into that thing. Budget where you can, try not to lifestyle up, make reasonable decisions, and you're gonna get there. You'll see what I mean. It's crazy how this stuff adds up. Before we dive into these specific retirement scenarios, I'm going to touch on something that will affect nearly all of us, and that's the decision of when to take Social Security once we decide to retire. If you simply do the break-even math, it'll incentivize you to wait to take Social Security. And by the break-even amount, I just mean when the scenarios cross and equal out from a value perspective. So if you take it earlier, or if you wait and take it later, what age are you when the total amount ultimately balances out between the options? And I'll be honest, I don't think that waiting for the higher amount is the right choice for most people with around $1 million to retire on or more. And I'm not providing specific financial advice here, but let me use myself as an example. Right now, the online tool at the Social Security Administration says that if I take my Social Security at 62, I'm estimated to get about $2,200 per month. Whereas if I wait till I'm just 67, so only 5 years later, I would get a much juicier $3,200 per month. So in my scenario, the break-even age in which the options balance out and the total amount paid are equal is 77 years old. And now I'm a relatively healthy person, knock on wood that I live a lot longer than 77, but I'm still going to take my Social Security at 62. This will allow me to grow my future dividends exponentially in retirement. It will also lower my taxable income in all future years, which Social Security directly adds to. So it's treated like the income you used to make from your regular job. This is a huge difference because it allows me to receive more qualified dividends at the 0% tax rate. And we're gonna dive more into this stuff here in the next section. Best investments in retirement. I'm not an advocate of the traditional 4% rule. This has us taking out 4% of our portfolio each year to live on. The math of the rule is sound, but I really don't like selling any of my assets to help create that 4% each year. I'm all about having dividend and interest income give us that 4% or more each year so we don't have to lose any shares in the process. When we retire, we'll turn off the DRIP or the dividend reinvestment plan, and instead we'll have the dividends and interest kicked directly out to our checking account to live life, pay bills, and have fun. The 3 types of investments that I find viable for a retirement scenario are as follows. Dividend ETFs that focus on dividend growth, dividend ETFs that use derivatives to increase the dividend yield, and real estate investment trusts, or REITs. Now, of course, there are other asset types. You'll still want some cornerstone holdings like VU and VTI, or some growth ETFs, depending on your portfolio value. So what I'm really saying is for retirees, those are the 3 types of investments that I think are the most viable in most scenarios. There's always going to be a balance, of course. I went into depth about JEPI and JEPQ in a recent video I made, and I'll link that in the description below if you want to follow more of that path. This video will focus on real estate, and more specifically, why I don't have any real estate in my portfolio and likely never will. Dividend growers are superior. I covered bits and pieces of this section in a recent video, so some of this might feel a bit repetitive. But the context is essential for understanding why I don't think that REITs make sense in your portfolio, especially for retirees. My favorite dividend ETF that focuses on a nice balance of dividend yield, dividend growth rate, and price appreciation is SCHD. SCHD is deceptively more stable than REITs from a price perspective as well. And we're going to dive more into some of those details here in a bit. I really do think that dividend growth ETFs are the only type of investment you need in retirement if they're producing enough income now to pay the bills before Social Security kicks in. SCHD, as an example, has increased its dividend payments by 10.9% annually over the last 10 years. So if you can squeeze out enough yield to live comfortably now, you're only going to exponentially increase your purchasing power in the future. And I'm not quite done yet. There's also a good chance that you'll pay $0 on all future dividends received in your taxable account. Qualified dividends use a special tax table that is entirely separate from your federal taxes when you file each year. The money received does not count towards your taxable income, and therefore it will never push you to a higher tax bracket. Let's look at what I'm talking about here. So I found this tax table on Investopedia out there, and you can see the IRS is the source for this information. And what we're looking at here is the special tax table for qualified dividends and long-term capital gains in the tax year 2024, so this year. So if you're married filing jointly, you'll pay 0% taxes on qualified dividends that you receive up to $94,000 of taxable income. So this is before that standard deduction. It's really well into the six figures that you'll still be able to capitalize on this 0% tax rate if you stay under that number. And then once you get over $94,000 of taxable income, or $47,000 if you're filing single, then you can see here that you'll be paying 15% taxes on those qualified dividends up to almost $600,000 or $518,000 respectively. So unless you make a lot of money, this is the most you'll pay on qualified dividends is 15%. And this income will fall anywhere from 22 to 37% on the normal tax tables. So the big thing is that this tax table with long-term capital gains and qualified dividends is completely separate from your federal tax tables, and it's tacked on at the very end. So your qualified dividends do not affect your taxable income in any way, shape, or form. That's one of the huge advantages. This also plays into why I think taking Social Security early is usually the better choice. If, for example, you're married filing jointly, and you and your spouse make $123,000 a year or less, you'll pay 0% taxes on your qualified dividends received in your taxable accounts. This is after considering the $29,200 standard deduction that you're able to take in 2024. And one more thing, when you both die, your kids won't even pay taxes on the capital gains. They get a stepped up cost basis on the inherited investments. Trust me, I've tried, I'm as nerdy as they come. You can't find holes in this stuff. Qualified dividends are elite. Real estate investment trusts. It's time to address the elephant in the room. I am often asked by you guys in the comments of my videos why I don't have or like real estate investment trusts. And I want to be crystal clear. I am not saying that REITs are a bad investment, so please don't take this out of context. I just don't see a point in holding them long term, or frankly, any stretch of time, compared to quality dividend stocks and dividend ETFs. I'm a buy and hold investor that doesn't consider the short-term price fluctuations as a decision-making factor in my long-term strategy. REITs just don't have a home in my portfolio. Stocks have been more volatile than real estate, but they've also had substantially better returns throughout history. And I want to be crystal clear that the recent underperformance of real estate has no bearing on why I don't hold it. So we're going to take a look at some numbers, and I'm pulling the recent history because that's what I'm able to effectively backtest with some accuracy. And real estate's been struggling lately. You can also slice out different points in time where real estate did extremely well. So I'm not cherry picking data to make real estate look bad. I'm just taking what I have to work with. But it is important that you know I am aware that real estate has had good stretches of time. However, if you zoom out 100 or so years, its 4 to 8% growth in real estate does not sniff the market's more volatile over 10% per year growth. And again, REITs pay non-qualified dividends, so they add to your taxable income, can push you to a higher bracket, and they're taxed at a higher percent in that current year, assuming they're in a taxable account. If you are interested in buying REITs, I highly recommend that you do so outside of your taxable accounts. Put it in your Roth IRA or your traditional IRA or any tax advantage retirement account. My favorite real estate company is Realty Income, ticker symbol O, which is structured as a REIT. It's probably the one that I would cost average into if I was going to have real estate within my portfolio. It's either that or maybe the Vanguard ETF VNQ, which gets me broad exposure at a low cost. SCHD will provide superior cash flow compared to O and VNQ. And you're probably sitting over there pushing up your glasses saying, well, actually, as you look up the yield information, but let's take a deeper dive into how this really works. I've pulled up Realty Income Corporation, ticker symbol O, out on Seeking Alpha. As you know, my favorite site to research stocks and ETFs, and I am partnered with Seeking Alpha if you are interested in trying the premium service for absolutely free for 7 days. If you like what you see, you'll save 25% on your first year. Link in the description below. So what I wanted to show out here on Seeking Alpha, I'm on the Dividends tab, and I just want to take a quick look at some dividend growth rates. So when you look at the 3-year CAGR, the compound annual growth rate, the dividend has grown at 4.2%. If you look at the 5-year, it's at 3.6, and over the last 10 years is at 3.8. So it tends to tread just above inflation. You'll keep your purchasing power over the years when you invest in O. And this isn't including price. I just wanted to show the dividend growth. Now we're jumping over to Portfolio Visualizer, and we're going to do some back testing here to compare SCHD, O, and VNQ, which is the Vanguard Real Estate Index Fund. So we're going to pull in as much data as we can. I just left this default 1985 through 2023. So in the first scenario, we'll start with 10,000, and we're going to aggressively dollar cost average 1,000 a month in. We're going to reinvest dividends and display income as yes. So we have SCHD as portfolio 1 at 100%, O is portfolio 2, and VNQ, that index fund, is portfolio 3. So we're gonna hit analyze here. And you can see we only have data since 2012. That's because of the age of SCHD, so we'll work with what we have here. The SCHD would be worth $344,000. O would be worth $243,000, and VNQ would be $230,000. So O did slightly outperform the benchmark of real estate. But I want to draw some attention to the best years are all pretty high. Looks like VNQ had the best year. The worst year, SCHD has never been down more than 5.5%, whereas VNQ was down 26 and O was down about 11.6%. Pretty nice stability with SCHD. And we'll take a look at the annual returns here. You can see SCHD is blue, O is red, and VNQ is orange. So SCHD got a slow start in 2012. Then it was boosted way up in 13. You can definitely see that they lack direct correlation, which can be considered good for a portfolio to have checks and balances. But as the years go by, SCHD seems to be a little more consistent than these real estate ones that are all over the map, as you can see. Whereas SCHD is never too high and never too low, except for it was pretty high in 13. But I like the consistency. If we look at the trailing returns, over the last 3 years, SCHD is up 9.5% to O's 3.1 and VNQ's 5%. Over the last 5 years, SCHD is a juicy 14% to O's 3.3 and VNQ's 7.3. Over the last 10 years, you have SCHD up 11% to 9.5, very solid for O, and mid 7s for VNQ. And over the full period of time since 2012, so I think that'd be 12 years, you have 12.7% for SCHD, 9.4% for O, and VNQ is 7.8. Now, total returns are great, but as retirees, we really care about the cash flow a little bit more. This is just an extra bonus. So on the portfolio income, you can see that SCHD here, the blue one, starts much lower than the other two. And O, the red one, is the highest. But then as time goes on, you'll see that SCHD is creeping up. All of a sudden it's past VNQ, and it's really close to passing O here, as you can see, because of its growth rate. So not only do you get the superior total returns, but with the dividend growing, you really catch up with SCHD over the years. And in 10 more years, trust me, the blue bar will be way up here and the red bar will be somewhere in here. Ultimately in retirement, we want good, consistent dividend income that specifically beats inflation, so we never have to lifestyle down once we're established. Now let's run a more specific retirement scenario, because that is, after all, what we're talking about in this video. In this scenario, we are starting with $1 million, but we are no longer contributing monthly and we are no longer reinvesting the dividends. So we are retired now and we are living on the dividends. We still want to display income. Everything else is the same. So let's hit analyze. Okay, in this scenario, SCHD started at $1 million and it's now up to 2.9 million. O is at almost 1.7 million and VNQ is just over 1.5 million. So the best years are still the same. The worst years are still the same. Nothing new to see there. And the annualized returns will also be the same. We don't need to touch on that. Really, everything's mostly the same up above, except for the portfolio income. So this is a realistic scenario where we're actually trying to live on this. So you can see at first you only get $31,000 a year from SCHD compared to O's superior $51K. But as you go on here, you can see that SCHD is making some progress year by year. And all of a sudden, O is slowing down a little bit and SCHD is still continuing to bolster its dividends. So about 9 or 10 years in, you're officially making more money on SCHD. And that's where the yield on cost actually does matter. SCHD will never compete with O's dividend yield when you go out and research them at any point in time. You're going to see 5 point something for O and 3 point something for SCHD, and you always think, well, O cash flows better, but it's just not how it works in reality. In 10 or 15 more years, and not just SCHD, but DGRO, and there's other growth dividend ETFs, these bars will continue to separate more and more in the future compared to barely pacing inflation with the other bars. So that's why I always emphasize zooming out and taking a long-term approach. People tend to get enamored with current yield. And again, as I mentioned earlier, real estate has been beat up recently, so these aren't completely fair comparisons. But when we zoom way out and we don't cherry pick any data at all, the stock market does win. And I'm not here to rain on anyone's parade. Let's figure this thing out together in the next section. Building the forever portfolio. We are going to retire at the age of 58 with $1 million in our scenario. We're going to take Social Security at 62 years old, but we have 4 years of a gap to bridge. Let's build this thing. Okay, I'm out on my dividend projector tool, and this one's out there for the channel members. And if you're interested in joining the channel membership, I've actually been asked this multiple times. There's a link in the description to this video below. So I know it doesn't show up on iPhones. I've received a few emails about that. When you hit the link, it should give you the opportunity to join if you're interested. So what we have here is $1 million portfolio for a recent retiree. We're going to go through some extremes and then we're ultimately going to balance this thing out. So to set the table, we have O, SCHD, JEPQ, which I didn't talk about in this video, but it's a higher yielding, lower growing option. And then a money market, which right now is at 5.28%. So what I have here for a very extreme situation is I put all 1 million in SCHD. And this is its 5-year CAGR. Its 10-year is 10.9. Actually, let's drop this down to 10. So this is below its 10 and 5-year because the recent history has been a little rougher, but I still want to show the difference here. So with a 10% dividend CAGR and only a 3.35% current yield, what we have here is an annual income of 33.5K on dividends. And that drops down to here. So this is the dividends made per year, and this is the dividends per month. And the purchasing power per year, so in the current year, it's going to be the same, of course, and the purchasing power per month. I assume a 3% inflation. You can change this on the spreadsheet. I like to assume a 3% inflation long term. A lot of people use 2.5, but I figure I might as well be a little more conservative. So as you can see with SCHD being the full portfolio, you start with a measly 2.8K a month. So if you don't have Social Security kicking in yet or other sources of income, this probably won't get you by at first. And you can see the purchasing power is 2,800 as well. Now, as the years go by, you can see your purchasing power per month really makes its way higher and higher the longer you look. So let's just pick 20 years. Let's look out 20, 21 years. Like in 2044, your purchasing power, $10,200 per month. So you're actually receiving $18,700, but it's as if it's $10,200 of 2024 dollars, accounting for inflation. So your lifestyle, like what you can afford, your purchasing power is drastically improving. Oh, I might not have been scrolled. Here's where I was looking right there, 2044 with SCHD. However, you have to take care of yourself now. And if 2,700 isn't enough, what we could do is let's check out the other extreme. So we're going to put it all into O. So now you have the full 1 million in O instead, or you could do something similar with JEPQ. It'd give you a lot. So now your yearly income is a juicy 58,000. You have 4,800 a month to work with, but you can see your purchasing power. What I want to show here is, well, it does go up a little. You have a 3.59%, and this is the 5-year dividend CAGR that I pulled. SCHD's was 11 point something on the 5-year, just to compare the two directly. But you'd see with 3% inflation, your purchasing power is going to go up ever so slightly. So when you come down to that 2044 again, like we did with SCHD, you're at 5,300 instead of over 10,000. This is just how it works, you guys. So you're receiving 9.8K a month instead of the 18,000. And it's only worth now, after inflation, 5,300 instead of over 10K. So you start with the higher amount, but it doesn't grow. And that dividend growth is so deceptive with the power of compound. So realistically, let's say you need, let's work backwards here. And I haven't done this yet, but let's just start with $500,000 in each of them. Maybe that'll give us something to shoot for. And I haven't done JEPQ yet. Of course, you just have less growth and more dividend yield. So it's sort of the more extreme version of O compared to SCHD. These two, SCHD and JEPQ, are worlds apart. And then you can always have cash too if you wanted. So I put those in here, but we're mostly playing with real estate versus SCHD, just as an example of a good, essentially REIT versus a good dividend growth stock. You can use other tickers and other options, of course. When you balance it out here, now you have a nice healthy mix of 46,000. That gets you at 3,800. And let's say we needed 3,500. So as you can see, we're beating inflation because you're getting a weighted CAGR of 6.8% here with this combination. And you're getting a weighted yield of 4.6. Now, since we only need 3,500 a month, this is where I'm saying we should probably start playing around with this. Like maybe we try a 600K versus 400K and see we're still at 3,600 a month. So you could even get a little greedier with the growth aspect. Like let's try something like that. Now we're at that 3,500 a month now. So we're getting by and paying bills, but then we get to grow way more in the future. So a way to summarize how this works is to say, whatever your tickers are, you don't have to have all your eggs in a couple baskets. You can have multiple. You want to keep your monthly income, ironically, as low as possible while fulfilling what you need to live life, because ultimately it's about that purchasing power in retirement and never having to scale back. If anything, you can loosen the purse strings as time goes. So you really want to focus on this dividend CAGR as long as you have the yield to support your short-term needs. There is no one size fits all when it comes to your retirement portfolio. I think the most important aspect for everyone is just to prioritize the future dividend growth as much as possible while getting by in the present. And it's also perfectly fine to include growth ETFs like VGT, QQQM, SCHG, or cornerstone ETFs like VU or VTI if your portfolio value can support it. Because these actually, believe it or not, grow their dividends over time as well. Plus it'll keep that price appreciating if you're just chilling and living on the cash inflows. There's nothing wrong with raising the value of your portfolio over time as well. Growth is actually more important than ever because we're living longer and longer. So it's not about mathing out, with bonds and CDs and cash, I can live to this age. It's more setting up a system that will take care of itself, in theory, forever. I hope this gave you a better idea of at least starting to think about how to construct your retirement portfolio. Thank you for sticking this one out to the end. And check out this video right here if you want to see how powerful a retirement portfolio with 100% SCHD really is. Thanks for watching, and I will see you here next week. Peace.